Hello there. Welcome to the Open on BNN Bloomberg. Happy Easter Monday. Let's check in on the markets as we get going today. There are hopes. There are hopes for a ceasefire in the Middle East that has been giving some support to stock futures today, and of course we're zeroing in on oil amid concerns that even if there's a ceasefire and it reopens the Strait of Hormuz, we're going to see curtailed oil exports for quite a while because of damage to facilities and the whole process of getting the system going again. So oil in focus today. Let's get perspective from Whitney Stewart, Executive Director and Client Portfolio Manager at Sterling Capital. Whitney, thanks very much. Can we start off with your thoughts on oil, please?
Yes, good morning, Andy, and happy Easter as well. So in our view, yes, oil is one of the three main factors the market is focused on right now. It's Iran, it's oil, and then AI is really the third one. So in our view, we try to use history as a guide to potentially project what may happen in the future. And historically, when you do get a geopolitical event, there's a 73% chance the S&P 500 will be positive 1 year later, and there's actually an 86% chance the S&P will be positive 3 years later. So for longer-term investors, we would actually potentially lean into this recent correction or decline. And if you look at oil shocks specifically, typically when you have a 20% oil shock, 1 year later, the S&P 500 is actually average up 18% positive, and oil is actually down 7%. So again, we tend to lean into history. And if you're a longer term investor, we believe that this may present opportunities to take advantage of the price action.
So typically in the past, I think you said if oil goes up 20%, the market, typically the US market is up 18% a year later.
Correct. Yes. Yeah. So again, it doesn't feel like that while it's happening when you have missiles flying and unfortunate loss of life, and you've got the Strait of Hormuz being closed, as you just said. It's 20% of the world's oil really not making it through the Strait right now. In China, it's 40% of China's oil comes through the Strait. So there's clearly risk. The question is about timing. And so, when you look at the history of the Trump administration in these potential events, almost exclusively, they have been great buying opportunities. So if you look back last year, the Trump tariffs, which obviously it has nothing to do with Iran, but it was a situation the market corrected 20%, great buying opportunity. You go back to COVID, another great buying opportunity. Back in Trump 1.0, 2018, there was a 20% correction. Another great opportunity to take advantage of those lower equity prices if you are a long-term investor. And in this specific situation, we do have the midterms coming up here. And the Iran war is not polling well here in America. So from a political perspective, economic perspective, incentives are very much in the way of driving a solution relatively soon, which would then likely the market would trade that as potentially stocks go up, oil goes down.
What about tech? We're looking at a 1 year chart actually a 1 month chart for oil. What a jump, 25%. Maybe we could show a 1 year chart for the NASDAQ 100, and oil now up almost 80% in a year. What are your thoughts on tech? I mean, tech has come off its highs.
Yes, tech is very bifurcated. So the entire sector is down. But if you look within the sector, software is the real trouble spot. That is clearly in a bear market, down more than 20%. And some of these stocks are down 30, 40, 50%. When we think about software, we're really focused on 4 M's, if you will. Do these companies actually have a moat that could be eroded by AI, or can they withstand the AI pressure? The market, is it about to get extremely competitive in their market because of AI making software coding significantly cheaper and easier? Margins, what are the margin profiles of these companies? A lot of these companies have had 80, 90% gross margins. NVIDIA's CEO simply recently said that he expects software margins to drop to 50%. So, 90 to 50 is a big change. And then lastly, what's the multiple? What's the valuation? These stocks are down, but in some cases, if you're 0 for 4 on the M's, maybe they're value traps. There could be some opportunities. You just got to be really selective within software, within tech overall, but specifically within software.
You're in the camp that thinks Microsoft will emerge a winner here?
Correct. Yeah. So within that basket of software, Microsoft actually is in that basket. We view Microsoft a little bit differently. It's interesting. If you go back a couple of years, it was all about the Mag 7. Now people are referring to the Mag 7 as the Lag 7. They're generally underperforming, Microsoft being one of the Mag 7. But if you look at Microsoft specifically, it does have one of the best balance sheets in the world. It's one of the only companies that's AAA rated. It's got 90 plus billion in cash, generates over 100 plus billion in cash flow. Yes, they're spending a lot of that cash on building out the data center. Even after they build out the data center each year, spending over 100 plus billion in cash, they still have a great balance sheet. So from that perspective, we feel very good about the downside risk associated with Microsoft. Then going forward, if you believe in AI, which we do, we think AI is a long-term game changer, there's going to be a few of these data center companies that really benefit. And so what I mean by that is Azure, their key data center unit, is growing almost 40% year over year. And we think that's potentially going to accelerate. And the reason for that is that AI compute demand is really, in our view, not being forecasted in the future correctly. If you believe Jensen, he believes that the AI compute is going to go up 1,000x, maybe even 1,000,000x from now. And so most investors are not modeling that into the expectations of Microsoft data center. We don't necessarily believe it's going to be 1,000,000x, but we do think there's a lot of upside in demand for compute. Microsoft directly benefits from that. Additionally, Microsoft has the trust of the existing Fortune 2000 companies. Almost all of them use some Microsoft product, so they can cross-sell other products. And then the key strategic change for Microsoft, in our view, is that initially they partnered almost exclusively with OpenAI. Now they're offering essentially any AI service, whether it's Anthropic, any other competitor, Mistral in Europe, they're all available on Microsoft's cloud. And now Microsoft is operating more like the Apple App Store, where they're just going to take a scrape of whatever AI product or service you want to use, as long as you're using Microsoft's cloud, the Azure. So we like that model better. We think that's more sustainable. There's less product risk. And then Microsoft does have great cybersecurity. So clients and customers are going to trust Microsoft's cloud potentially over others. And therefore, we think Microsoft's actually a long-term beneficiary of AI, not a loser associated with AI.
And you were talking there about Jensen Huang, of the CEO of NVIDIA, forecasting this massive increase in compute needed. Yeah, the reading I've been doing on AI, just the amount of data that needs to be crunched, it's just mind-blowing, okay, to teach these systems. Enersys is a stock that you like the look of. Can you remind us what they do, please?
Yes, Enersys is a smaller company. It's a power management company. So they are not exclusively an AI play. They do have aerospace and defense, which is improving. They also sell, batteries to forklifts, which is not the best business right now. But where they're seeing a lot of growth, as you would guess, is in the data center business. That's growing well over 25%. And the bottom line is these data centers need a ton of power, right? So they need battery storage. Enersys is supplying that power. That business is scaling rapidly. Again, we think it's still early, and that's a clear pinch point in the data centers, because it is very hard in the U.S. to get utilities up and running. There's a lot of regulation. So new power coming online is growing, but not nearly at the pace needed to meet the demand of the power from the data centers. So therefore, you need other forms of power, right? So Enersys steps in a battery management solutions.
We're going to have to jump. Excuse me. That was Whitney Stewart, and Whitney really appreciate it. Whitney Stewart, Executive Director and Client Portfolio Manager at Sterling Capital. Coming up, we're going to focus on the Strait of Hormuz and those new threats this weekend from U.S. President Donald Trump. U.S. President Donald Trump on social media overnight, threatening once again Iran's energy infrastructure. Meanwhile, U.S. allies are pushing for a ceasefire. We had a look at oil. It's been trading north of $100, near $110. Some shipping is getting through the Strait of Hormuz, but we know that this oil disruption is going to last for quite a while. We got more from Ernest Wong, head of research at Baskin Wealth Management.
The reality is that you basically can't predict what's going to happen with these kinds of things. Obviously, I'm talking beyond the wild tweeting and those kinds of things, but
they were wilder than usual, it felt like, on the weekend too.
Yeah, and whether the motivation there is posturing for negotiations, I don't really have an opinion on that. I think what the lesson that we've all learned from not just the Iran crisis right now, but also from 2022 is just how reliant the world is on a lot of these things that are being manufactured and the supply chains on places like Qatar, not just for energy, but for things like fertilizers, for things like helium to make chips, for things like sulfur to refine nickel. And I think that every time there has been a crisis like this, the world has responded in a way to diversify their supply chains out of that region and look elsewhere.
And that's really a healthy thing, though, isn't it, at times?
Yes, and that's exactly...
It's like not putting all your eggs in one basket.
And that's exactly what we saw after the 70s, when there was a similar event in the Middle East. The world shifted towards developing oil resources in other parts of the world. The world started to move towards energy efficiency and renewable energy, and I think we'll see a similar push like that going forward.
Now, one thing with the Strait of Hormuz is the big thing about this, but at the same time, we've seen Saudi Arabia divert. It has a pipeline going north to the Med, I believe, right? It's diverted more oil towards that. Could that be something that they consider on a larger scale?
On a
larger scale, that they can divert most of their oil and go north with it rather than try to get through the Strait of Hormuz?
Well, my understanding...
Not now, but like longer term.
Yeah, so I think that is certainly something that is going to be... I think all options are on the table at this stage. I think the Middle Eastern suppliers are going to be looking for ways to use both existing infrastructure as well as building new infrastructure to really look for alternative market access following this event. And I think the pipeline that you mentioned is going to be one example of that.
And you talk about we found alternative sources. Are there more alternative sources for those things in the world? Is this something Canada... Could we see a benefit from this?
No, I think certainly Canada is very, very well positioned to be benefiting from this. We have oil and gas, obviously, but we have helium, we have fertilizer, we have sulfur, and I think it will be on the government of Canada to start to develop market access to other places and really show that Canada can be a reliable supplier of these products in the future.
Do we have the guts, do you think?
No, I think certainly the Prime Minister is making the right moves. And especially with the Kuzma review coming up, I think that there will be a lot of interest from both Asia and Europe to look to Canada as a supplier of these things as well.
And how are you approaching this from an investment point of view?
So I think our approach from an investing perspective is we really don't focus on the headlines and try and trade in and out of these things as they happen. But what we try to do is focus on owning high-quality companies, because what ends up happening is that the stronger become stronger during these times, and they end up gaining market share, maybe through acquisition or by holding lower prices, and end up stronger on the other side.
And are there any companies that are standing out when it comes to that are looking well-placed in this?
Well, so certainly a company like Costco, for instance.
Yeah.
Costco is known for having the lowest gasoline prices. They usually benefit from higher gasoline prices because people are looking for value. And so as more people look to Costco for lower gasoline prices, they get more memberships, and they end up gaining market share over smaller chains that do not have that ability.
And can they weather the inflation better than the smaller companies then too?
Oh, for sure. Because
I mean, that's one of the big things I think we're looking at right now. March numbers are coming out. I think we'll see some numbers we won't like.
Exactly, because again, Costco is the cheapest place that you can buy high quality produce. And so this happened in 2022 as well, where Costco was a massive beneficiary of inflation in those times, because not only did their profits go up because of inflation, they also gained market share by having lower prices than other retailers and higher cost suppliers.
And we've been pretty lucky in Canada because, I mean, you're starting to hear the horror stories in Asia about massive restrictions for oil. And yet we've felt it at the pump, but we have not felt it beyond that.
No, and I think that it is really I think that's one of the understated benefits of this. You never want to benefit from wars, but Canada is going to end up benefiting from this event, both directly through higher tax revenues, through the economic potential generated from higher oil prices for the oil companies, and longer term as we are building out the infrastructure to help really sell our natural resources to the rest of the world.
Ernest Wong joined us earlier. He's head of research at Baskin Wealth Management. Coming up, Stellantis, we're hearing, in talks to sell Chinese-made electric vehicles in Canada. It looks like it's going to be an assembly deal. There are lots of implications here for the Canadian auto sector. Canada's electric vehicle market is set to shift gears. The Prime Minister announced a deal to bring in 50,000 Chinese electric vehicles under a pretty low tariff. But there are questions over who exactly will supply these cars. Will some of them be assembled in Canada? A Bloomberg report suggests that Stellantis may be the first major automaker to step up. It reported that the company, Stellantis, is in talks with China's Leap Motor to build EVs at Stellantis' vacant Brampton, Ontario plant. We got more from Flavio Volpe, president of the Automotive Parts Manufacturers Association.
Stellantis is under a lot of pressure, both from the union, Unifor, as well as the government, and as well as part suppliers, to come up with a plan for Brampton, which had idled, which when it wasn't idled in 2024, made 150,000 cars, had $7.5 billion of industrial activity, bought $3 billion worth of Canadian parts, employed 12,000 people locally, said come up with a plan. The report yesterday was that one of the options of the plan is work with Leap Motor to import knockdown kits. That would have zero local content on them. It would have 300-400 jobs. And the only industrial activity, the only investment in that plant that was any Canadian content might have been, $20-25 million worth of wages for the year. And so we've been pushing back. Lana Payne and the union pushed back. And I saw the minister today say, well, we're not going to allow that. And I think that's really important. It's a devolution of the industry. It's not an incremental investment. It's saying bye-bye to billions of dollars of activity and tens of thousands of jobs.
You want to see a full regular plant that builds cars from the ground up?
Well, there is a full regular plant, and the company that owns it says, oh, well, wait. When we see that we get restored access to the U.S., I promised the CEO promised the Prime Minister that we would see a product there. They've got product that they need to assign, and that assembly plant has been assembling vehicles, not knockdown kits, since 1962. And there's no sense in taking a bad deal and locking in all of these losses. Better to wait the next few months to see if we regain that access, and then push the company to live to its obligations that it made to the union, and the tacit promises that it's made to the community, to the province, to suppliers that serve it in all other places. In fairness to the company, they didn't leak this news. I don't know who benefits from hearing one of these options, but it's important for all of us now to understand what a CKD is. CKD versus assembly is kind of like, think about IKEA. You and I could go buy a sofa and assemble it. It was manufactured somewhere else, came in a box. You and I are not manufacturing sofas. A CKD plant in Canada is not an assembly plant. It's not Canadian manufacturing. It's an import quota cheat, and we should call it out.
So CBU apparently stands for a completely built unit. And then CKD stands for completely knocked down. And that's more the IKEA approach.
Yeah, that's right. Yeah, CBU or whatever plain English language you want to use is, hey, if you're going to make a car, that means you're going to source the parts from local factories to meet the USMCA 75% compliance. You're going to buy steel from Dofasco or Algoma. You're going to buy aluminum from Quebec. And you're making a go of it like everybody else that's had to invest to make a go of it here, and that you're going to restore the employment of the people who work in that plant and the people who feed that plant. If you're doing CKD, which is these IKEA type arrangements, you are bypassing the import quota that has a cap. You know, you can only import 49,000 vehicles by saying, oh, this is assembly. Well, you're just making the jigsaw puzzle there. You're putting it together and you're selling it like it's a picture that's on my wall. Anybody who does CKD here should have that count against the Chinese import quota, because that's all it is. And for one of the 5 companies that makes cars here to be allowed to devolve to a CKD is a terrible signal, but also a competitive threat to the other 4 who would be under the same pressure to the same. Why would we do that?
Flavio Volpe of the automotive parts manufacturers. Let's have a quick look at U.S. futures as we count down to the opening bell. Looks like we get a modestly positive open, but not very much. There are still hopes, of course, that some kind of a ceasefire will be agreed, despite rhetoric from both sides. Let's have a look now at gold and see how it's been faring. We have heard reports of central banks selling over the past while. It looks like some central banks locking in gains. The Polish central bank has suggested that gold be sold to pay for extra defense. But fascinating that central banks, after helping to drive gold up rapidly over the past 2 years and more, with massive purchases and maybe some of them divesting their gold holdings. Let's have another look at oil. Andy Lippo, longtime oil observer, frequent guest, says that petrochemical prices are now up about 50% with the shutoff of supplies from the Gulf. We're going to have the opening bells next. There you have it, the opening bells on Bay Street and Wall Street. At the NASDAQ, Latham Group is ringing the bell. In New York, at the NYSE, Charles River Laboratories. It's time for the first 15. Let's check in on the equity markets as we get going. I'm just looking at the S&P. Oh, we've jumped ahead to Barrick Mining. Well, okay, let's have a look at the broad markets, or if we okay, we'll do the TSX first. So since the attacks on Iran, the Israeli and U.S. attacks on Iran began on February 28th, the U.S. market has declined. The broad U.S. market is down about 4%. But of course, the TSX has had something of a boost from higher oil prices. Nevertheless, still down about 3.6%. So that's interesting. Our market down despite the rally in oil stocks. Of course, gold has come off the boil. Let's have a look now. Do we have the U.S. markets? And there you have them. The S&P 500 marginally higher, but it has been an ugly few weeks. As I say, with the U.S. benchmark, the S&P 500 down almost 4.5%. Some stocks here of interest. Barrick is slowing down the building of its Reko Diq mine in Pakistan. They had highlighted already that they started a review. Apparently, one of the concerns, the project's security arrangements. This giant, biggish project anyway, is in Pakistan near the Afghan and Iranian borders and Baluchistan. It's not the most salubrious part of the world. You get separatist action. Sometimes the rule of law runs a bit thin, so they are slowing down. National Bank says Reko Diq accounts for about 6.5% of Barrick's asset value. MDA is attracting attention as it planned south of the border. They just did an IPO of their stock and listed in the States. Jefferies starting coverage of the Canadian space technology provider at buy, saying it has space to run. It combines a deep space heritage with tech advantages to offer cutting-edge solutions in satellites, geo-intel, and space robotics, and the backlog has swollen. RBC adding Chorus Aviation, which, among other things, provides flight services to Air Canada, operates aircraft for Air Canada, to its Canadian small cap conviction list. Stock not doing much, but you can see up almost 20% in the past year. RBC thinks it's a compelling value opportunity, and it also, as part of its business, has some defense. And of course, that's attracting investors right now. Extendicare gaining another bull verdict from analysts. Look at the move up in that stock over the past year. It's well over doubled. TD Cowen starting coverage of the senior housing provider and upgrading it to buy, and talking about Extendicare's home health care business, saying it's going to drive above average growth. The company has pulled off at least one acquisition lately in home health care for people who need some help but want to stay in their home. Couple of chemical stocks on the radar here. Dow and LyondellBasell, chemical providers in the United States. Oops, I think we went to the Dow Jones Industrial Average. It is a bit confusing, but in any case, B of A downgrading the stocks after their massive run. Now, as of Friday, Dow was up 35% since the attacks began at the end of February, and LyondellBasell was up 38%. So those stocks have been gaining on a perception that the market is going to run short of chemicals with the lack of feedstock and basic chemicals coming out of the Gulf of the Persian Gulf. Thank you, Control Room. There's a look at Dow stock. Okay, so the conflict in Iran has been rocking global markets, but our guest sees opportunity in Canada, both in the current environment and the world that will follow. We'll be right back. Okay, the conflict in Iran moving on, entering its sixth week. America's allies said to be pressing for a deal with Iran. However, U.S. President Donald Trump still talking tough and threatening once again to destroy Iran's power plants. Our guest says that during a volatile period like this, Canada's stability and reliability presents an opportunity for investors. Let's get more from Matt Kaser, president of FSA Valuation Service. Matt, great to see you, and thanks very much. We'll get to your ideas on oil and gas in a second, stock-wise, but it certainly does cast Canada in a favorable light as a stable supplier.
Well, yeah, I won't argue with that. I think that's probably the number one supplier in terms of stability and quantity. A number of factors. I don't have a scorecard on that, but I'm just kind of articulating that Canada is a very secure place to be, and get supply for around the world for obviously oil and gas and minerals and precious metals and things like that.
Have you changed your portfolio significantly since the end of February?
Actually, I made very little changes. I didn't want to overreact to all of this. It's not noise. I was going to say noise, but the volatility was so high And I just felt like, no, you're going to overtrade this. If you overtrade this, you're going to, you're going to chase the wrong thing and you're going to sell something too early or something like that. If you have a good, stable portfolio, you don't have to get caught up in the headlines. And I think it's a big mistake to get caught up in these headlines. The big picture is there is increased geopolitical risk, which has been on for several months now, like 18 months at least, maybe a bit longer. So that part hasn't changed. Yes, it's gotten a little bit more volatile. I would not take, say materials have gone way down recently. I would not take that as a signal to get, oh, that's the end of the line. I think that's more of an opportunity.
CNQ, Suncor attracting your attention. Suncor coming out with a pretty bullish forecast at its investor day last week.
Yeah, we do a lot of like quant work, so we're looking at return on capital and the cash flow the company generates, and it's always been a really good profile for us. So it's a great block and tackle name. Anytime we can get a little extra news on that, that's great. But really, we're holding it just for the great return on capital, the consistency, the dividend, those sorts of things. It's great if they can have a good investor day and give us a little more juice.
Tell us about gold. Are you overweight gold? Do you have a significant weighting in the yellow metal?
Yeah, I think I'm overweight. I'm not sure my exact percentage at the moment, but I would probably be overweight. We had been trimming a little bit, only because we had done so well over the last 18 months. And then we kind of got to the point where, okay, this is a good level. And then it peeled back when the war started, and we were tempted to actually buy more. So I would say, we're more looking at a new entry at this point, as opposed to, selling and going underway. I would definitely think this pullback is an opportunity.
In gold?
Yes, correct.
Right. One name you like, Endeavour Mining. They're huge in West Africa.
Yeah. So again, we're doing our quant model here. It's one of the highest return on capitals, and it's also been improving. We love improving returns. So if you go from a 3% to a 5% to an 8%, I think it's around 13% return on capital, the way we calculate. And I won't get into all the details, but we do a lot of accounting adjustments to make it a cash on cash return on capital, and it's one of the highest and one of the best improvers. So we love the improvement there. I probably wouldn't be my first choice though, because West Africa, it's a little bit smaller market cap, although not that small. And I'd probably point people to, if you're not in gold, because I feel like a lot of people miss gold. At least that's some of the comments I'm getting from people. I'd probably go with an Agnico Eagle. It's more, it's larger cap, but it's got assets around the world: Canada, Finland, Australia, Mexico. It's just kind of a safer entry point, I would say, or way to get into gold.
What about the telcos, including BCE, our parent company? I'm not sure if you saw that TELUS, BCE, and Rogers were downgraded last week by TD, which is concerned about ongoing price cutting and competition.
Yeah, I can see that. We have very low weightings in those. It's hard for us to get excited. Kind of the one that we do play the most would be Quebecor. But yeah, we're not. I kind of agree with the framing of the question was like, is there some issues there? And yeah, I think I think so. I think it's a tough environment.
We better jump, Matt. Thank you very much indeed.
Okay.
Matt Kaser, president of FSA Valuation Service. Let's have a quick look at wheat, because there is a intriguing story on Bloomberg that hedge funds have turned bullish on that crucial food commodity for the first time in 4 years. I think I remember reading that wheat is the world's #1 source of calories. You might guess it was rice, but I guess in East Asia, South Asia, a lot of wheat is consumed as well. Apparently, for the first time, in nearly 4 years, these speculators, the hedge funds, have turned bullish on wheat. And it's partly because of dry weather in the US, but also a shortage of fertilizer and fuel. So this Strait of Hormuz thing keeps showing up because obviously fuel has become more expensive, but massive amounts of fertilizers come out of the Gulf through the Strait of Hormuz from the Persian Gulf. Let's have a quick look at Pepsi. I think it's PE, PepsiCo. Interesting, more of a showbiz story here, I know. But a London music festival has lost sponsorships from PepsiCo and Diageo, the global alcohol firm, because the festival booked Kanye West as the headline performer. The Prime Minister of Britain, Keir Starmer, called the booking deeply concerning. I think you might say that the management of that festival should they should have read the room a bit better. That rapper has been in years of controversies that have included praising Adolf Hitler. Let's have a quick look now, another quick look at gold, because it's been such an intriguing story that it hasn't acted as the natural refuge that you'd think. Gold pretty flat today. There is a report about a diplomatic push for a ceasefire in the Iran war. So bullion trading near $4,700 US an ounce. This report came from Axios, which is an American political news site. Axios saying the US, Iran, and regional mediators are discussing terms for a possible 45-day ceasefire. And okay. And just to remind you, on Thursday on Market Call, we were joined by Richard Orell, portfolio manager at RN Croft Financial. He was covering ETFs, and his top picks were pretty conservative idea here, the iShares S&P TSX Composite High Dividend Index, XEI, Vanguard Developed X North America Dividend, I see a theme there, and then a Global X 0 to 3 T-bill ETF, another basically cash or like a money market fund. Today on Market Call, it's Stan Wong, portfolio manager at Scotia Wealth Management, and he'll take your questions on North American large caps and ETFs. Up next, Blue Owl, south of the border, a major supplier of private debt funds, has been facing heavy redemption requests from investors. And of course, there are contagion fears. We're going to look at that when we come back. Blue Owl investors are trying to pull more than $5 billion from two private credit funds. And of course, this could make it harder for a once hot corner of Wall Street, private credit, to attract new money. We spoke with Bloomberg's Brian Chapata.
We've seen them exceed 5%. A lot of managers have capped it at 5%, but usually the redemptions were something like 7, 8, worst case 10, 11%. But this was 20, this was 40%. These were really massive withdrawal requests that a lot of investors just wanted out. And Blue Owl, like other funds, basically had to throw up the gates and say, you know, we told you that we could limit 5% withdrawals if we need to, and that's exactly what they did.
And the worry, I think, is in particular the software industry, because equities have dropped, plunged for many software companies. Is Blue Owl thought to be particularly exposed here?
Well, the technology fund definitely is. Mm-hmm. They basically cited that in their letter, that one of the reasons that this was hit particularly hard was because they did lend a lot to software, and they were particularly concentrated in that space. But their flagship fund also saw 20% withdrawals. And like other private credit funds, they do have a pretty large exposure to software. They're pretty much known for that. They actually invest a lot in AI, but also in software. So they're kind of exposed on both ends of the spectrum. And look, they've been a relative newcomer to this space. They only became Blue Owl just a few years ago. So when you compare them to the Blackstone, the Apollo, the KKRs of the world, who have been around for decades, they are a new player. They grew really fast, and now they're kind of seeing the tide turn a little bit.
And it's complicated, isn't it? Because they different funds, they're sold under different mandates to investors. And so have some questions been raised about the differing treatment of investors in the funds?
Yeah, you bring up a good point. I mean, Blue Owl specializes in some of these non-traded BDCs, as they're called. They're not on a stock exchange like some other private credit funds. So what you do see is you see these vehicles that people are just now starting to understand have these redemption limits in place. So you actually can't get all your money out necessarily when you need to if a lot of other people want to as well. So there's a lot of education that I think a lot of investors are learning about that even Blue Owl executives themselves have said maybe we didn't do as good of a job of telling people ahead of time that this was something that could happen to them.
There have been many learnings, as Borat used to say. Thank you very much indeed for joining us, Brian Chapata of Bloomberg. Let's get more on what's happening with Blue Owl. We're joined by Dan Rasmussen, founder and portfolio manager at Verdad Advisors. I'm not sure if you heard that report from our Bloomberg partner there, but
I did.
What is jumping out for you with this situation?
I think the thing that you have to understand, I think we're in the early stages of a credit crisis in private credit. Right now, we have not seen major defaults. So the flows are really anticipating defaults. And the problem here is that it's a slow motion bank run, right? As investors pull their money out, it gets harder to refinance, liquidity dries up. You start to see who are the levered holders of these private credit firms. They start to get in trouble. And then finally, you get defaults when the firms go to refinance and they can't because there's no borrowing capacity out there.
That's interesting. I guess with these things, it's fear itself is the problem. And you're saying the underlying companies, we haven't seen a whole bunch of them failing to meet their debt commitments.
Not yet. I mean, there are a fair number that are picking, right, doing payment in kind, and that's obviously a bad sign. But the real problem will come when they need to refinance, right? And there's certainly a wall of refinancing that's going to start probably in 2027, 2028. So we're not there yet, but the market pricing and the BDCs moves ahead of those defaults, and the flows move ahead of them. They're leading indicators, so they will come. But this private credit crisis is real, right? These withdrawals will generate reflexively their own, self-reinforcing downward spiral for the asset class.
And so BDCs are business development companies. Can you remind us what those entities are?
Yeah, they're essentially publicly traded private credit funds.
Okay, thanks. Yeah. Now, we hear a lot of talk about problems with credit at software companies. Private equity has poured money in. Is that one of the underlying problems at Blue Owl as well? Software companies, investors just looking askance at them as AI spreads?
Yeah, so the private equity boom of the 2010s was financed by private credit, right? They're two sides of the same coin. Mm-hmm. And private equity and private credit went very deep into software. It was thought that software was eating the world, that therefore you should invest a very large percentage of your funds into software in order to garner that excess return. And then during COVID, essentially that was supercharged. So rates were very low and software seemed like it really was eating the world, and everything was moving online. And so people paid crazy prices for software companies for 3 or 4 years and put crazy amounts of debt on. I think everyone knew it was crazy at the time, but they had to, when the music was playing, they had to dance. And now we're seeing an unwind of those bad vintages and those bad sets of deals, which were concentrated in the software sector. And now AI is hitting software, and so it's doubly bad. But yes, that's the apex of the problem. But there was a lot of bad loans done in other sectors too. But certainly tech was the biggest problem.
And we're looking, BlackRock is down, not as much as KKR or Ares Management.
Yeah, those ones are more credit heavy. The more credit heavy they are right now, the worse they've sold off. But the private equity businesses are going to be in trouble too. I mean, they're not getting the headlines, but private equity is subordinated to private credit. So if the private credit's this bad, the equity's got to be worse. Yeah,
that's interesting. We kind of forget that, don't we? The bondholders get first dibs. It's interesting as well. We've seen this push in both the United States and Canada to get retail investors into private investments. It seems like an odd time to be doing that.
Well, it's an odd time if you're thinking from an investor perspective, but if you're thinking from someone who owns these assets perspective, you're saying, well, gee, let's sell them to retail. Let's get them off our books and into their books and bail us out. And so I'm really hoping it doesn't happen. I don't think these are suitable for retirement accounts. I don't think retirement accounts should be paying 4 to 5% a year in fees on any type of asset, and certainly not for private credit.
Wow, is that what you're looking at, 4 to 5% typically?
Yes.
Wow, that's quite a take. You need to be investing in some high yield debt to actually justify that. Leave us with
essentially what they're doing is they're lending at quite high rates, and then they're back levering it. So it's maybe 1.5x back levered. And that leverage is often coming from regional banks. And so what we're sort of thinking here is wondering where the contagion is going to spread, right? Who's exposed to private credit that we don't right now know is exposed to private credit? I think the insurers are an obvious one, the life insurers, the annuity providers, and then how much of these, the regional banks provide in liquidity and financing to help with the back leverage. And then who else are sort of the holders of this stuff? Because they're going to be in a lot of pain, because in a lot of cases they thought and underwrote this as investment grade credit, which it certainly isn't.
And some of these private equity and private debt players, they've been buying life insurers, haven't they, to get access to the annuity cash?
Exactly. They've been raiding the float. So they've thought, wow, if I controlled an insurer, I could invest all of that insurer's float into my own company at 4 to 5% fees. And wouldn't that be great? I'd have permanent capital at high fees. And they truly believe these investments were good investments as well. So they thought, and it's going to help the annuities. But I think it's all unwinding. And the question is, how exposed are these different insurers and annuity providers and reinsurers? And we're going to find out.
That's interesting. Annuity money being used for some of this stuff. Dan Rasmussen joined us, founder and portfolio manager at Verdad Advisors. Back leverage in private debt refers to a borrower or investor taking out additional debt as at a parent or holding company level. So it's extra leverage. Coming up, crude around $110 US a barrel as the conflict in Iran enters its 6th week. Welcome to the second hour at the Open. Let's get to the big stories we're bringing you from our newsroom. Traffic through the Strait of Hormuz has been increasing as countries secure safe passage deals with Iran. 21 ships transited over the weekend, and that was the highest level since early in the conflict, which began at the end of February. But despite the increased traffic, this is still far below the roughly 135 vessels that passed daily before the war. Iran is granting exemptions to select partners while advancing legislation to formalize transit fees, possibly tightening its grip on global energy flows. OPEC and its allies agreed yesterday to raise their oil output quotas by over 200,000 barrels per day for May. It's only a modest increase relative to the current oil shortfall, and that reflects the fact that many of OPEC's key members are unable to raise production due to the war with Iran. Saudi Arabia, the Emirates, Kuwait, and Iraq are the only countries in the group that are able to were able to significantly increase production prior to the conflict. Shares in Barrick Mining down a bit. That giant producer is slowing development of its Reko Diq project in Pakistan, citing escalating security risks in the area. The company says it will scale back expanding and will extend a project review until the middle of next year. Barrick says it still sees long-term value in the project, but warned that costs could rise from earlier estimates. A look at the TSX holding its own today. Amid hopes that some kind of movement towards a ceasefire is taking place, U.S. allies apparently anxious to see an end to the fighting. And let's have a look at the U.S. markets. They've been suffering, but they are gaining back a little bit of ground today. Let's get more from Jim Thorne, Chief Market Strategist at Wellington Altus Private Wealth.
Good morning.
Great to see you. You're a student of history. Is there anything in the current situation that investors are missing or underemphasizing, do you think, Jim?
I think people are positioning themselves for an elongated war, and I would suggest that it's going to be a shorter war. That's one. And two, when you go back and you look at history, let's say the fall of the Berlin Wall, end of the Korean War, the period after the war is fantastic for risk returns. So I am suggesting, as we've talked previously, is that we should be selling the war and positioning for peace. And Andy, my North Star is the 10-year yield in the United States. Last April, when it got to about 450, right? Because there's so much debt, right? And Scott Bessent said this is what he anchors off of. You saw the Trump administration pivot and soften on tariff. When we got to 450 this time around recently, the same thing happened. And now
sorry, Jim, to interrupt. Let's have a look at a 5-year chart for the 10-year bond yields. Carry on, Jim.
And so it's sitting around 430, and it's down a touch. And so the credit markets are at least indicating that there is a fair chance that there's going to be some resolution to the problem. Because if they didn't think that, the 10-year, I would suggest, would be close, the yield would be closer to 5%. So I'm anchoring off of the credit market saying there is going to be a resolution. And then how do you position your portfolio moving forward?
A bit confused, though, and maybe I'm taking it up wrong. If people were worried about the war dragging on, would they not tend to seek a haven in U.S. bonds, and that would push the yield down?
Yes, but at the same point in time, the counter would also be that people would get be really concerned about the fiscal state of the United States, and they would start selling U.S. bonds, and that would be a larger wave of selling as opposed to the buying.
It's incredible. Yeah, the cost of this war, you're spending, some of these missiles cost hundreds of thousands of dollars, and you're using them to shoot down cheap drones.
Yes, but, we're going to get, if the president is successful, and remember, Andy, he's using J.D. Vance as his negotiator, and J.D. Vance is anti-war. He is true far-right MAGA. And so what I would suggest to you is, when we get this war over, people have got to really start to think about these things. For example, oil is, $110, let's say. Oil companies hedge out. So are people really thinking that $110 oil today is going to immediately translate into earnings for oil companies? The piece that you just did earlier about Barrick, the easy money in mining has been made. Andy, you know as well as I do that mining is a very difficult business. Now it's about execution. And you've got so I think you've got people positioned the wrong way. They're positioned for a recession in the United States. They're positioned for war. And I would suggest that you're going to get a cyclical recovery in the United States, and you want to position for it.
What about stocks like technology and healthcare?
I like technology in the sense that it's the cheapest it's been in a while. I think healthcare is a place where people are hiding out. Healthcare, staples, energy. And so what we need to see is a rebalancing of the book. Back in the 80s, late 80s, early 90s, when the Berlin Wall fell, the following year you had a 30% return in the S&P 500. And so when you hear me talking about the return of the peace dividend, that's what I am talking about. And then, Andy, we've got the July 4th, 250-year anniversary that Trump's talking about, and the midterm elections. That's why I say to you the credit market is signaling an early resolution to this. And I would suggest if that is the case, you want to get pro-cyclical.
There's been talk of inflation, and we are going to see at least some because of the jump in fertilizers, petrochemicals. But your take is that this is not going to be a sustained increase in prices?
Yes, it's very encouraging that the governor of the Bank of Canada has gone on the record to say that, for the time being, he's going to look through the increases in prices because of the supply shock, which he should, and so has the head of the Fed, Chair Powell. So I am not in the camp of raising rates. I think we need lower rates, but then again, you've got the Governor Macklin basically hoping that the real estate market in Southern Ontario can recover with the rates the way that they are. And we shall see. We shall see.
Yeah. I'm just looking. Apparently, there's a conference coming up in Canada. They're going to feature some Harvard experts who say that growth obstacles in Canada's cities, these municipal charges and NIMBYism, are a major problem for the economy because cities are where growth occurs because in an information-focused age.
And we've been implementing these policies for decades. This is not a quick fix, and it's a well-known problem. So we need to understand that there needs to be significant policy changes at the local and at the federal level. And I think we're coming to that, but it takes time, Andy. And that's the problem I see with so many people up here is the fact that they think that there's a magic bullet. Yes, we've identified the problems. The policies are going to be changed. How long does it take to change? And how does that manifest into returns for the TSX? That's the big question.
This productivity thing has so many facets to it. Is it a cultural problem, though? Is there a lack of entrepreneurial spirit in this country? I know that's very vague.
Well, I spent a lot of time in the United States, professionally, and so there is an edge down there. There's no doubt about it. For entrepreneurship, we need to make Canada attractive to capital, and we need to make it attractive for entrepreneurs to stay. Yeah. And right now, I would say over the past 15 years, that hasn't been the case.
I read an op-ed by a tech startup guy, and he said in Canada, you go to see funds, and they're like, well, let's keep talking. And he says, no, I don't want to talk. I want money from you. And said in the States, they're willing to put up the money faster.
They put up faster, and they're also willing to cut it off faster. I mean, that's the thing about it's business, and it's lethal. It's fast in and it's fast out. It's a completely different pace to the game. And there are some things, I decided to come back here. So there are things I like about Canada. Oh, yeah. At the same point in time, we need to get back to the entrepreneurial spirits, which we had.
Yeah, Leave us with the final thought, Jim. When you look at the Canadian banks, let's put up the old banks index. Do you have much money in there? Are you overweight? It's always a question in my mind. Should one just dump a whole load of money into the Canadian banks? Historically, they've done so well.
Well, let's be honest, they're the best run banks in the world, arguably, right? That said, and we know that the Bank of Canada has kept, I personally think they have kept rates too high. So you're seeing a transfer of income from Main Street to the banks because of the refinancing of mortgages. That ends next year. So I think banks are okay this year. I think their dividends are safe. But I would suggest to you the rubber meets the road in 27 with these banks.
Well, Jim, we've only got 10 seconds. What do you mean the rubber meets the road?
The Canadian fundamentals, if they don't improve dramatically, will filter into the bank's earnings.
Jim, always great hearing from you. Jim Thorne, market strategist at Wellington Altus Private Wealth. Coming up, investors focus on the Strait of Hormuz and the latest threats from U.S. President Donald Trump. That's ahead. U.S. President Donald Trump reissuing threats to attack Iran's energy infrastructure. Meanwhile, U.S. allies are pushing for a ceasefire. Our partners at Bloomberg TV set the scene.
the deadlines are oft delayed, but there is an escalation or a change in tone and language. You noted the very salty posts by the US president, most recently reiterating, but in unusually graphic terms, his threat to the Iranians to effectively lay waste to the country. He's made similar statements in multiple media interviews in the interim. Many of your viewers will be aware of the term deal heat from the world of business. That is when one side of a negotiation is so keen to close the deal, they might actually be rushing into a bad deal. I wonder if this delaying of deadlines and the increasingly heated language from the White House might be suggesting a deal heat on the part of the United States. The Iranians certainly don't seem to be under any pressure. They're pushing this off. They're sticking to their demand for full reparations, they say, for the war and a full exit of U.S. forces before they consider unshackling the Strait of Hormuz, which they've effectively taken over. So time will tell. We're now waiting for that latest deadline, which you cited. The war continues, certainly when it comes to what the Israelis are saying. They're not especially optimistic. There'll be a deal, and they see every day as potentially one in which to gain further achievements against their archenemy, Iran.
Kasia, what do we hear out of Washington, D.C.? I mean, the president's post yesterday seemed, frankly, a little bit unhinged. Are senators and Congress people worried about the president here? He's using increasingly religious language as well.
Matt, look, here in Washington, we are pretty used to all of this. We are used to President Trump setting new deadlines and issuing threats. But you're absolutely right. Over the weekend, Trump increasingly focused on this graphic language, threatening Iran with bringing hell and blowing everything. What he wants is for Iran to open the Strait of Hormuz. He's very concerned about raising oil and gasoline and jet fuel prices, and he knows he has to address it. So we will hear more from President Trump today. He will speak at 1 p.m. He will give a press conference here at the White House.
I mean, he said before that he doesn't care if they open the Strait of Hormuz, and he doesn't need anyone's help. Also that he needs everyone's help. He's used, I believe, the F word for the first time in a post, and I haven't heard previously the God is great or any kind of praise to Allah language in his tweets. Seems increasingly desperate. What are we expecting to hear from him at 1 o'clock?
I agree. It does seem increasingly desperate. Trump also previously have told Americans that it's worth to pay perhaps a little bit more at the pump to suffer this short-term pain for the long-term gain for Iran not having nuclear weapons. I do expect him to focus on this theme again today to kind of talk about what is the goal, the long-term goal of this war, which is also something he has struggled to communicate, and he is facing increased criticism. Obviously, Democrats use the weekend shows to go out and criticize what looks like lack of strategy, urging President Trump to tone down the rhetoric and seek a solution. But again, we'll see at 1 p.m. whether he will do anything like this. I think this 1 p.m. press conference will focus more about on President Trump praising U.S. military. He really wants to come back to this victory rhetoric. He wants to praise the operation over the weekend, which led to rescue of U.S. airmen from inside Iran after U.S. jet crashed down there. There was a 2-day rescue operation that resulted in bringing this airman back, and Trump has already said that even as he's wounded, he will completely recover.
Dan, what do we expect in terms of military action? I mean, you're reporting from Israel, where Benjamin Netanyahu has grown used to being accused of war crimes. A lot of people are saying that if the U.S. were to attack power plants or desalination plants, that could also be considered a war crime. Does that matter? Will it happen anyway?
I think behind the scenes, the Israelis and the Americans are concerned that should this threat be carried out, it might risk alienating the very population that both Trump and the Israeli Prime Minister Netanyahu said at the outset they would like to see take over Iran after, as they put it, the regime would be demolished or degraded sufficiently to be toppled. So aside from the legal issue which you cited, I think there's a practical concern here in terms of the long-term, long-range ramifications of such attacks. For now, the Israelis are pursuing classic military targets, as they would call it, saying that overnight, for example, they killed the chief of intelligence for the Revolutionary Guards Corps, a significant achievement, albeit someone who had apparently not been in office that long, given the succession of senior chiefs being killed and replaced in Iran. So the Israelis, for now, in terms of their public statements, will continue focusing on senior personnel, on nuclear targets in Iran, ballistic missile targets, and other military targets. They've indicated in the past an ability to hit energy targets. However, that has been one-off attacks, and it will remain to be seen. As usual, Trump, I think, calls the shots in this war, including when it comes to changing target sets. I'm not sure the Israelis would relish entering into that fray in terms of civilian targets, but time will tell if even the Americans will do that.
Dan, thanks so much for your reporting. Bloomberg's Dan Williams there on the ground in Israel. Kasia Klimasinska in Washington, D.C. Now, both Brent and WTI, as you saw earlier, are coming down a bit right now, though at relatively high levels and after some fluctuation this morning as traders weigh reports around the war. Let's get more with Bloomberg's Anthony DePaola. Anthony, what do you see in terms of, the ever-rising price of crude? What kind of knock-on effects is this having on the economies that need that oil?
Good morning, Matt. As you mentioned, crude is higher today, fluctuating, bouncing around as traders have a lot of information to take in. We've got, as you mentioned earlier, those conflicting deadlines and timelines on in terms of potential for peace talks or all-out attacks. So that's lots of whiplash there. Plus, we've got some other data out over the weekend from an OPEC Plus meeting yesterday, where they agreed to add some barrels to the market that they can't really add because Hormuz is closed. And then we've got Saudi Arabian oil prices from state producer Saudi Aramco, where they're giving record increases on some grades of crude that they can't supply, again, because Hormuz is closed. It's their main Arab light crude that they've increased really to records. So these things are all pushing oil prices higher. And that is creating the strains that we're seeing on the economies because the crude is simply not coming out of Hormuz. The producers, the major producers in OPEC Plus, which have a lot of spare production capacity, particularly in Saudi Arabia, they're not able to bring that to the market because they don't have the export capacity. That's having the knock-on effects because refiners aren't getting the crude oil. We're not able to produce diesel for trucks, jet fuel for airplanes. And so that's really having the knock-on effects. And we're seeing that where you are in the States, where gasoline prices are increasing. So really impacting that. And it will be a bigger impact the longer that Hormuz stays shut, Matt.
Few interviews there today from our partners at Bloomberg TV. Coming up, we're going to talk to a former chief economist at NASA about the potential cost of building and sustaining a long-term human presence on the moon. Traffic through the Strait of Hormuz has been increasing as countries, or some of them, secure safe passage deals with Iran. 21 ships transited over the weekend. That's the highest level since early in the conflict, which began in late February. Despite the increased traffic, however, it's still far below the roughly 135 vessels that passed daily before the war. Iran is granting exemptions to some partners. Iraq, for example, says it has won an exemption. The Iranians, though, are also pushing forward with legislation to formalize transit fees, potentially tightening Iran's grip on global energy flows. Shares in Barrick Mining slipping 2%. That miner is slowing development of its Reko Diq project. in Pakistan amid escalating security risks. The company says it will scale back spending and extend a project review until mid-2027, citing worsening regional security and potential increases in capital costs. Barrick says it still sees long-term value in the project, but it warned costs could rise from earlier estimates. A new polling suggests a majority of Canadians think Canada should explore joining the European Union. The survey by Spark Advocacy found that 1 in 4 Canadians think it's a good idea for Canada to formally join the economic and political bloc. Now, 58%, wow, pretty high, indicated that the proposal was worth exploring. Apparently, the results suggest Canadians are increasingly open to finding ways to ditch this country's reliance on the U.S. after more than a year of tariffs under President Donald Trump. And there is a look at the TSX Composite today, holding its own. Of course, we are seeing oil prices nominally in North America at around $110 US, but globally, people for oil for prompt delivery are paying as much as $140. So there's a massive increase in energy prices and costs around the world. The TSX year to date is up, it looks to me, up 4.5%. The S&P 500 is down about 3.5%. Speaking of which, let's have a look at the American markets. And you can see they are up a little bit today. Starbucks is doubling down on its, quote, back to Starbucks transformation. It has a new program that expands tipping options and bonuses based on performance. Now, of course, the bonuses could add to labor costs in the near term. One of the plans may be here, though, keeping unionization or more unionization at bay. We heard more from Nick Setyan, Managing Director and Senior Equity Research Analyst specializing in restaurants at Mizuho Americas.
When ordering digitally, you're going to get a pop-up saying, hey, would you like to tip? And before, it did not exist.
And do they think that will work, or I mean, doesn't that run the risk of driving people away? A lot of people, you hear them talking about how they're tired of tipping.
Well, it's definitely awkward for the customer. I mean, I think what they're betting on is, that the customer has gradually gotten used to it. If you order on third-party delivery, et cetera, and many other apps, you're asked to tip. And so Starbucks is actually now one of the few apps where you're not asked to tip. And so they're really just joining the fray. And the hope is to switch, the continued labor inflation onto the shoulders of the customer as opposed to the shareholder. There is ongoing labor inflation, and the goal is to essentially mitigate that by, at least for this year, putting some of that on the shoulders of the customer.
So the bonuses, I think, are tied to sales and customer service. So do you think that this is going to increase accountability at the store level, or do you think it's just going to create more competition among the workers?
I do think that it's going to increase accountability. I mean, I think what they're doing is aligning the bonus structure with what you see across, many other restaurant chains. Starbucks was a little behind, given, not necessarily behind, but a little different in terms of what their focus over the last few years was, particularly around digital transactions and speed and throughput. I think now the focus is going to be a little bit more on service metrics as opposed to operational metrics.
And I guess the bigger question, does it feel like this is going to work? Is Starbucks heading in the right direction?
Near term, we are seeing an acceleration in traffic trends. To me, I think this is neither here nor there. I mean, I think it's at the end of the day going to be a neutral impact on transaction trends. And on the margin, it should mitigate some of that labor inflation that, we all expect to continue.
So do you think that Starbucks could expand this program beyond the US and into Canada as well?
I do. I think it's a high probability scenario.
Are they the same, Canada and the US, or are they very different beasts?
They're very similar. They're very similar. In fact, when they talk about the business, they talk about North America versus the rest of the world, and that includes Canada. So the U.S. and the Canada operations are very similar.
And would it be difficult to bring that in here, or are the rules essentially the same in Canada as in the U.S.?
I don't think it would be very difficult to bring that to Canada. So I do think it's a very high probability scenario that you guys start to see, tipping prompts on the digital apps as well.
And then from the union perspective, do you think this will help keep the unions at bay?
The unionized stores are about 5% of the system. I don't think that it's going to keep the unions at bay. I mean, at the end of the day, they've seen wages, cash wages, prior to any benefits, et cetera. Cash wages have doubled at Starbucks since 2019, with the hope that it would keep the unions at bay, and it hasn't, right? It hasn't resulted in any kind of a slowdown in the unionization movement. And so I don't necessarily think this is going to keep the unions at bay.
And then I think big picture, do you view this as kind of reinforcing the back to Starbucks transformation strategy, or is this more of an incremental move?
I do think that it reinforces the focus on service. That's part of the back to Starbucks strategy. And at the end of the day, it does, on the margin, mitigate some of the labor inflation. The context is Starbucks has gone from over 20% North America operating margins to low teens operating margins. So we've seen about a 10 percentage point decline in operating margins, in profitability in North America. And that includes a lot of the investments around Brian Nichols' turnaround strategy. And so anything that they can do on the margin to mitigate the cost headwinds is welcome.
Is there more that could be done, do you think?
I definitely think that costs are going to be a focus going forward. I think the North America margin expectation is that we're going to expand from sort of that 12 to 13% range towards 17, 18% over the next 3 years or so, 3 to 4 years. Investors need visibility that that's a realistic scenario for the share price to go higher and valuation to go higher. What we've seen is an acceleration in top line without a commensurate uptick in the share price. And that's because of the skepticism around the margin trajectory.
Nick Setyan joined us there. He's a restaurant analyst at Mizuho Americas. Coming up, hot picks. We're going to get 2 gold ideas and 1 in copper. On Hot Picks today, we're looking at a couple of gold ideas and a copper miner. And our guest is Martin Pradier, equity research analyst at Veritas Investment Research. Martin, great to hear from you. Thanks for joining us. Just jump in. Let's get going. Wheaton Precious Metals. You say the valuation is higher than gold miners, but it always is.
Yes, that's always been the thing. But what is important here is that Wheaton Precious Metals has 40% of the revenue coming from silver. And silver has increased even more than gold. So gold has increased 17% last quarter compared to last quarter, and 69% compared to last year, same quarter last year. Silver has increased 55% compared to last quarter, and 169% or 63% compared to the same quarter last year. So the revenue is growing very fast. The other thing that is important is the growth. No gold miner has this kind of growth. Most of my gold miners have basically no growth. And the best one is Agnico with 15-20% up to 2030. These guys have 50% up to 2030, 11% this year, so a lot of growth. The valuations are cheap. I mean, you look at the valuation and it's the lowest it has been in the last five years. It's one standard deviation below the average, so less than 16% of the time has been at this low. So it's great. And then my next pick, and the other thing is, Wheaton doesn't suffer with oil price increases because the costs are fixed. And this is the same for my second pick, that is Franco-Nevada.
Okay.
So both have this advantage that because they are streams or royalties, the price of gold that they pay is always fixed. So Franco-Nevada is also interesting. And why it's so interesting is, well, they have like 85% is gold and silver, mostly gold. And then there's a 15% that is iron ore, oil and gas. Specifically, oil is about 7% that will increase with the oil price. And then they have some growth, and the growth is 4% this year and about 12% up to 2030, which is not that fantastic. But they have a big catalyst. And the catalyst is Cobre Panama coming back. And we think that there is a 70-80% probability of that happening. And if that happens, then the growth up to 2030 is about 45%, really interesting. The stock doesn't reflect that in the valuations. So the valuations, again, are very, very cheap, less than one standard deviation, below one standard deviation. So again, it's not priced in for sure. And you have all this upside if it happens, and we believe it's going to happen. The last one is a copper name, Hudbay. But this is so we have a price target of 46 with a 54% upside. And this is a different kind of copper name because 40% of the revenue is coming from gold. And that gives you a lot of protection. So this company, in 2023, so not so far ago, had an average cost of $1.92 per pound of copper. And then gold prices went in a tier, and now the cost in 2025 was negative 22 cents, and it's going to be negative even more this year. And with that cost, they are the lowest cost producer by far of my sample that has most of the copper names. Then the other thing that's interesting is the growth. Nobody has this kind of growth. So they have, because they're finishing, they're going to decide on World Copper, which is a big project. That will increase the copper produced by about 50%. Now, they just are in the process of buying another project that is called Cactus. And if that happens, that will increase the production up to 160% in 2032. So 50% 2030. If Cactus happen, 160%. So it's huge growth. And both projects have unusual internal rate of return. I haven't seen that many in my professional career. So the IRR of World Copper is 90%, 90. And the IRR on the other project, in the project itself depends of the copper price that you assume is 450 is 23. If you assume 6 is 35%. But they're buying that at a discount. So they will finish with a 40-50% IRR on these projects. And why is this important? Well, at the end of the day, the shareholders are the one that they're going to benefit. So if you're buying a company that has a 50-60% IRR, eventually you're going to receive that as a shareholder. So this is very good. and it trades at a 40% discount compared to the peers. So, you're buying one that has a lot of protection, it's trading very cheap. So I think it's a very good idea.
Martin, great hearing from you. Thank you very much. Martin Pradier of Veritas Investment Research. Artemis 2 circling the moon with a Canadian astronaut, Jeremy Hansen, and 3 American astronauts on board. What about the economic drivers, the potential rewards, and the costs involved here? Let's bring in Alex McDonald, a senior associate at the Aerospace Security Project and former chief economist at NASA. Thank you very much for joining us.
Yeah, pleasure to be here. Thanks for having me.
Just remind us, the Artemis program, there's going to be a few more missions through 2028, and they will culminate with actual lunar landings.
Yeah, so the Artemis program actually is currently planned by NASA to be effectively indefinite, because the goal of Artemis is to not just return to the surface of the moon, but actually build up a permanent presence there. So, we'll see where we get to, but the actual plan is to be able to build a habitat there, possibly multiple habitats now. In fact, last week, NASA rolled out a new set of commitments to robotic lunar landings prior to human landings, which are indeed scheduled for around the end of this decade. But they would be planned to continue through the 2030s with installation of power infrastructure, potentially R&D projects that might learn to use some of the resources that are on the lunar surface, like oxygen and water ice. So yeah, there's actually a relatively indefinite commitment that's happening here.
Is there a real economic payoff here, though? Because the moon is barren and they don't have much stuff. They don't have anything that I know of, maybe some isotope of hydrogen that isn't available on Earth.
Yeah, so the main economic benefit is really just the technological advancements that any country that invests in space exploration gets. My kind of favorite fact on that is that between 1960 and 1963, 75% of all global semiconductor demand came down to space programs.
Wow.
So basically, space programs became a way of scaling one of the most fundamental technologies of the modern world. GPS, telecommunications, satellites, space-based internet. All of these things come from investments in the space program. That is going to continue. In terms of this question of resources, the water ice is predominantly used for astronaut consumables as well as potentially rocket fuel. There is also discussion of helium-3, which is a different isotope of helium that might have use in fusion and potentially quantum computer cooling. So there's some potential applications, but really the main investment is really showing world leadership. As we know, during the Cold War, America's landing on the moon really kind of established U.S. technological supremacy. And there's going to be a similar process playing out here. China has its intentions to land on the moon by the end of this decade as well. And how and when the different countries land on the moon and the capabilities that are established will signal a significant amount of global leadership. So there's multiple different layers to the type of investments.
There have been, the original Apollo program was curtailed because of cost. And then there was another major initiative aimed at the moon, but that too was called off because of the expense.
That's correct. So we're now on our third attempt to return to the surface of the moon. Of course, right now, today, we are succeeding in the very first element of that. Today, there will be essentially a communications blackout period of about 40 minutes while Jeremy Hansen, the Canadian astronaut, and his 3 American NASA astronaut colleagues, Reed Weissman, Christina Cook, and Victor Glover, all go around the far side of the moon. That is happening today. And then they'll have a 4-day return back to Earth. So this has been the result of about 15 years of committed investment dating back to the 2010 NASA Authorization Act that Congress passed and was signed into law. The first attempt to try to return to the moon was the George H.W. Bush era Space Exploration Initiative. That submitted a bill to Congress of half $1 trillion, over $1 trillion today in inflation-adjusted terms. That was canceled. So what NASA did to reestablish this program was to rely on 2 different core strategy elements. One was to rely on international partnerships. Canada being, of course, the first country to fly as part of Artemis. But there will be other countries as well. The U.S. is committed to landing Japanese astronauts on the lunar surface. The European Space Agency is also a major partner. They actually provided some of the service module that was used on this mission. So the international component will be lowering the cost and in getting more political kind of alliance benefits as well. And then the second major difference, of course, was the reliance on the commercial sector. The two companies with contracts to land astronauts on the moon are Blue Origin and SpaceX, which are respectively owned currently privately by Jeff Bezos and Elon Musk, the richest people in the world. So there's been a very different strategy that's been taken, and thus far that has proved to be very effective at getting a sustained program going here.
Yeah, I got my helium and hydrogen isotopes mixed up there for a second. Has Elon Musk, with his rockets, has he significantly lowered the cost of getting people into space?
So he has significantly lowered it, but not necessarily as much as people might realize. In fact, some of NASA's costs actually are going up. Where he's really succeeded is creating a vertically integrated company that has managed to use this capability to reuse rockets to launch his own Starlink satellites and create the largest constellation of satellites in history. So the cost has been reduced, but not necessarily by the many orders of magnitude that people have hoped for. Of course, Starship is looking to reduce the cost even further. If that vehicle is fully successful, it will be fully reusable, and the hope then will be to be able to reduce the cost of spaceflight by perhaps another order of magnitude. So we are seeing significant reductions in cost. We're seeing, perhaps even more importantly, significant increases in the number of launches. We're now up to 100 plus launches a year. This is the highest there's ever been. So we're really at a boom time in terms of space launch and particularly in terms of satellite production. We're now at well over 10,000 satellites in space. 75% of them are in fact owned by SpaceX for the Starlink satellite constellation. So there's certainly a lot more activity going on now than there's been in a long time.
That's exciting, Alex. Thanks very much indeed. Alex McDonald, a former chief economist at NASA. Up next, we're going to check in on the markets on Bay Street and Wall Street. Let's check in on the markets before we go and maybe have a look at an intraday price for oil, because Bloomberg says Iranian TV is reporting that Iran has rejected a ceasefire. That was in reply to a U.S. proposal. They've been going through Pakistan. They're rejecting a ceasefire. They're demanding a permanent end to the war. Okay, so it looks like no progress right now, but the Iranians reiterating their desire for a permanent end. There was talk of a 45-day ceasefire as they searched for a more sustained deal. Let's have a look now at the big stock indices to see, are we seeing any red ink on the risk of, not right now on the TSX anyway. The TSX driven higher today. Let me just check out some of the big value traders. Toronto Dominion Bank holding its own. Canadian Natural edging up. Royal Bank of Canada higher. Royal Bank of Canada up almost $2, but no clear pattern on the energy stocks. Cenovus, last time I checked, and Suncor were slightly down. And let's have a look at Wall Street, the U.S. indices, to see how they're faring. So they are narrowly up still. Big traders, as usual, NVIDIA and Tesla, both of those are down. Micron and SanDisk, the memory chip companies, are up. Of course, they've been booming, partly because this huge AI build-out has created shortages of some electronic components. And I'm just looking, Amazon higher by around $2. Thanks very much indeed for watching The Open. We've got morning markets up next.